guys, Chris Clothier here with another episode of the Grind Podcast. And this week I'm actually recording a little bit early, and I'm going on to, I'm going to use a Facebook Live into our Facebook group to kind of talk about a topic I discussed last week in our podcast. So if you're on Facebook Live and you are not already following the Grind newsletter and podcast, this is your chance. We'll make sure we put a link in there if that's good with you. Where you guys can follow and subscribe to The Grind, get the weekly podcast in your inbox, get the weekly newsletter every Tuesday in your inbox, get Kent Senior's executive letter every other Sunday where he kind of gives you some of his thoughts on the current market and the strategies and things that he's done and used through over 50 years as an entrepreneur. But for today, this is me talking about interest rates, and I wanted to go live in our Facebook group to give them some access to this information before it goes out on our podcast. And if you're listening on the podcast, let me just start with a big thank you. Nothing will have changed between today and Friday when we release this out. This is my take on what's happening out there with interest rates. I don't see anything big. It's really not just interest rates, it's the housing market as a whole. But talking about interest rates being a big part of the discussion today in the investment world, out there in the investment environment. People want to know what's happening with interest rates. There's a lot of fear and misunderstanding out there, so I want to make sure I clear some of that up and tell you kind of where I think the housing market is, where it's going based on the past couple of decades of being involved, and based on the fact that I do read a lot, talk a lot, listen to a lot of people that I respect. I'm just going to give you kind of my take today, kind of as it's been shaped by some others, out there in the industry and talking. I've got 6 key points I'm going to cover today. They're going to be discussing inventory, discussing interest rates, discussing wage growth, discussing new construction, how that's going to affect the current housing market, foreclosures, how they will affect, and what's going on with rental rates. So those are the 6 main topics that I'm kind of going through. It won't be super, super long. This is going to be a quick and easy one that you guys can follow. If you are in the Facebook group, guys, be sure and post any of your questions that you have in here. I will be in here throughout the rest of today and really all this week to happy to discuss anything with anybody and share your viewpoints. If you think that I'm dead wrong, go ahead and let me know in there. Let's talk about it. That's what the Facebook group is all about. It's not just it's not a one-way street. So with that being said, guys, these are the 6 things I think are really affecting the housing market today and how it's going to affect it over the next 12 months. Number 1 is the tight inventory. This is something that we've been dealing with as a country and as investors going back for well over a decade. When the housing crisis hit and began to really, really affect, the economic crisis began to affect the housing market, that was 2008, 2009. Since that time, we have not had 1 year where housing new starts is able to meet new home formation. So therefore, basic consumption, the numbers that we need for new house formations have not been met since going back to 2009. We're talking about now it's almost a decade and a half of underbuilding. What that means is that new home formation, that is people that are living in apartments that want to buy their first house, people that are moving out of some other scenario. Maybe they're living at home. Maybe they have been renting apartments, houses. It doesn't really matter where they've been. They are forming that new household formation that we're going to buy our first house. We have not built enough units to meet that demand. Add on top of that demand from people that are selling their first home, looking for that move up house. They're going from the starter house to the first family home. We have not built enough to meet that demand. And then of course, kind of, I guess the one part that I wouldn't necessarily say it's been met, but it's been met the most is that luxury high-end home, because there's just lower demand for that. We've been building plenty of that type of inventory, but not enough of the lower priced inventory, the first home, the second home, that inventory. And so we look around today, there's just not enough houses on the market to meet demand. There are not enough new house starts to be able to meet demand. So you have very basic economic scenario here. You have high demand, low inventory. I believe that in and of itself is going to keep pricing of homes high. Now, what our biggest concern, I think, as investors is the buying power that we have of the dollar that we have. So every time interest rates go up, it's not that housing suddenly becomes less affordable. It doesn't change the value of the houses at all. It changes our ability to be able to afford what it is we're buying. So it erodes the buying power of our dollars. It brings it down. Interest rates now have gone up, I think, 3/4 of a point this year, expecting at least another half point. There are many economists that are kind of back and forth. Is it going to be another half point? Is it going to be a full point? You've even got some that are going as far as to say that before the end of the year, they think the Fed will have overreacted, reacted too slowly, reacted too late, and in order to avoid a scenario of stagflation where you have high inflation but stagnant economy, they will look to be lowering the rates before the end of the year. Hell, nobody knows exactly what's going to happen, but here's where we are today. Interest rates are higher. They are still historically low by historical standards. So, the last time we had rates at these levels, we were looking back in the late 2000s, I believe is when it was, maybe mid 2000s. So we have interest rates that are high. They're certainly higher than what we've been experiencing over the last 3, 5, 10 years. But I definitely believe that there is room for a reversal of those interest rates at some point over the next 12 to 18 months. There could be a slowdown because we've seen of course, the reporting is that the economy is not as overheated as it was. So they may not do 2 half-point interest rates raises, but no matter what they do, here's the point. Home prices remain high. Our buying power goes down every time they raise interest rates, but it doesn't mean that we can't buy. It doesn't mean we shouldn't buy. It doesn't mean that it's going to force some form of a housing crisis or some form of a correction where suddenly going to lose all the value. No. If we're buying houses for investment, we just simply add all the numbers. The interest rate, what we're paying for the right to borrow this money, is just a line item. It's just a number in the calculation. We need to make sure we properly account for it, see what it does to our monthly income on the property. Does it allow us to cover and reach the expectations that we have when we're buying a property? And that's it. If the answer is yes, then hey, we move forward. I truly believe that in the future, a lot of us as investors, we took advantage of falling rates over the last 3 years. So I know that I refinanced a couple of times as rates went down. That opportunity will be there for us again in the future, I firmly believe. The next, as I said, 3, 5, 7, 10 years, you're going to have an opportunity to be able to refinance what you're buying today. But for any investor that's on the sideline saying, well, I'm going to stay in cash. I'm going to keep, I hate this phrasing, these goofy things that people say. I'm going to keep my powder dry, to get ready for the next foreclosure crisis, which I'm going to get to in a second. The next wave of houses falling, and I'm going to be right there with my cash ready to buy. Well, guess what? Your cash will be worth less on that day than it is today. So if you have the ability to be able to control a really good asset and earn a really good return on that asset right now, by not taking action, we risk not, buying a property with more dollars later. Maybe it costs more. Maybe it cost me more to borrow the money later. Either way, the buying power of my dollar goes down the longer I wait if I'm in an environment where I know interest rates are going up. That's my quick take on interest rates for anybody that's sitting out there waiting. What do I do? Do I sit in cash or do I take advantage of it now? Look, if you know that you want to invest in real estate, and for me, like I'm just talking straight to single family investors, but really this is for anybody out there. If you know you want to buy single family homes, you know that you are able to purchase a property that you have a firm belief will have a demand by renters going forward. You'll be able to keep it occupied. You're buying a property where you're holding down deferred maintenance. You have a relative good expectation of not having a lot of maintenance over the next few years. And you know that once you put all your calculations together, no matter what the borrowing price is, you're able to make money on that investment, then there's no reason not to move forward. And a terrible reason not to move forward is that I'm going to wait and see what happens in the future with housing prices. Because that's one thing we don't know what's going to happen. All the data says housing is not going to crash. Certainly not on a national level. In some areas, it could come down. You're going to see overheated markets that are going to come down in value, but not significantly. And in the meantime, before that happens, your dollar is worth less because interest rates are expected to go up. That's one of the things that it's a known fact or factor right now. All right, so that's the take on interest rates. The third thing that I think is really affecting the housing market today, and it's in a positive way, is wage growth. So we cannot deny the fact that wages are growing. They're growing at the fastest rate, I think, since back in the mid 1980s. Now, in an inflationary environment, that doesn't mean a whole lot because wages are going up, but so is the cost of everything. So that's what's kind of forcing wages to go up. We know that there was a lot of stimulus money dumped into the economy over the past 2 to 3 years. Is that are we still feeling the trickle effects of that? I don't know. I think that what we're feeling right now is that consumers continue to buy, consumers continue to spend. There are plenty of jobs out there. We have relatively low unemployment, at least based on the numbers we're told. That is by people that are looking for jobs. So people are able to find jobs. We do see wages are up. So as long as wages are up while we see interest rates going up, housing going up, rent going up, it means that some people who in a traditional market may get priced out. If wages weren't going up, they're not getting priced out. They're still able to afford the things that they need, like housing, and they're able to afford some of the increases that we're seeing. All right, the next big thing is new construction. Look, new construction will help, and if we can see an increase in new construction, an uptick in new builds, that's going to help big time. But the fact remains, there's big headwinds for the building and the construction industry. Materials are up. As I just said, wage growth is up, which means labor costs are up. You have a lot of builders that are still sitting on land saying, wait a second, does it make sense for me to build right now? We've thought it did, but now with interest rates rising, some demand coming down, it makes affordability issues for some on the edge buyers. Now you have builders saying, we're still not going to meet basic consumption needs for 2022. I think economists are split right now on whether we are or are not. There's still half the year for that number to go up or down, but it's going to be close. I will say one good thing for new construction. We're going to do more this year than we did last year, which is going to be big. Just to the tune of several 100,000 more homes being built in a year is big for us. It alleviates some of the price pressure. But as long as there's a lack of inventory, that's almost like this self-fulfilling prophecy. As long as new houses aren't being built, current people that are living in houses, they're not going to just go in and be in a rush to sell their house. They're not going to be in a rush to get their house onto the market because they know with high demand and low inventory, their houses are going to sell. And then what are they going to do? What are they going to find next? And you start seeing this ladder where I'm selling my house at this price, but I have to go up here to be able to find less demand. Somebody selling here has to go up here to be able to find less demand. It's this kind of self-fulfilling prophecy. Because nothing's available, I'm going to sit tight and not sell. That keeps inventory low, which keeps prices high. So even in a inflationary period, with interest rates going up, I think wage growth, the lack of this huge uptick in new construction, tight inventory, it continues to help us keep prices down. So what's going to change inventory? Are foreclosures going to change inventory? A lot of people have said foreclosures are going to change inventory. That's not going to happen. So foreclosures are not going to change the inventory situation. I think that in some areas, we're going to see a normal foreclosure rate return to many markets around the country, only because they've been held back due to the pandemic. It's not because there's some sudden economic shift that's going to make a bunch of people lose their homes. It's been there. It's a number that's been there going back to the middle of the pandemic. Is it going to cause this huge increase? No. But there will be some foreclosures. What we have to price in today that did not really exist on this level a few years ago is that in the bigger markets, the top tier markets, the secondary markets, the tertiary markets, those, the top 50 markets around the country, iBuyers or these institutional buyers, they make up large percentages of the current purchasing. So I do not see that changing. Even if foreclosures happen, you have this massive demand from these institutional buyers that are going to jump in and buy a lot of these foreclosures. I don't think they're going to affect the actual market itself and drive pricing down. I don't see it happen. I don't see the numbers so far from the data telling us that it'll be such a big wave that it'll drive it down. Certainly not on a national level. And then the last thing, the sixth, kind of point I want to make about the market today is rental rates. Rental rates continue to rise, although they lag behind home values, and they certainly don't go up in the same rate or by the same values that home values go up. But we do see rents rising. I know as a company, we saw the largest rental increases in one quarter in the history of our company. And we weren't trying to necessarily drive rents up. We were, of course, looking at market rent. We do a great job, I think, as a company of keeping residents in homes. We prevent move-outs from occurring. But we put a focus on making sure that we were getting as close to market rent as we could get without forcing a move-out. And many of our residents appreciated that and were able to, work with those rental increases. Because of that, we saw the largest increase we've seen in any quarter in the history of our company. And I still don't think we're at full market rent across the board, which is not a bad thing. It's partially why we don't have massive move-outs, that we have incremental growth in rent, not these big jumps that force homes to go vacant. So I think that there is room for rents to continue to go up because of that, and because there's just such high demand. These, if you go back to the very first thing I said, new home formations. Every year, new households get formed through marriage, move-outs, moving out of the parents' home, whatever it ends up being. There's a lot of demand for really high-quality rental houses. So if I can't, a lot of buyers are thinking to themselves, if I can't buy my first home, I can rent my first home, and then my true first purchase will be that second house, that kind of move-up house. And so for the right property, managed the right way, cared for the right way, there's massive rental demand out there. We continue to see it to this day. As of last week, we're managing right at 7,500 homes, but we had less than 80 vacancies last Wednesday across the portfolio. There were roughly an additional 80 that were just beginning to go vacant, that we're just getting into. So the true total vacancy is less than 2%. But my point with that, there's less than 1% that's actually on the market for rent, and it's taking us less than 20 days to get properties rented on average. Some take a little longer, some obviously are super quick. But my point is that there's just high demand, especially in the markets that we're in. So I think that's going to continue to keep inventory levels low. That's my take on the housing market right now. I know we get a lot of questions on it. We get a lot of people that are, it's not even fear. It's just there's a lot of unknowns. But we've been through this. We've been around now for over 2 decades as a company. We've been through the up, the down, the back up. We're gonna feel it down at some point in some ways, whether it's the economy or housing. But we've been there and had some experience with it. We're not just sitting here telling you we're the experts by any stretch. I'm not. I'm simply telling you that we've been around this. I know what is coming next and kind of how this market feels. And when I say I know what's coming next, is I know that based on reading other investors, other economists, listening to others, kind of taking this, not a poll, but this kind of pool of people that come together and say, hey, this is what we really feel confident in. So I'm confident in telling you this is what I think is going to occur. Anything can happen anytime, but it comes from experience and it comes from listening to others. It's not just me jumping out there on a limb. So look, if you have questions, if you want to engage in the conversation, join us in our Facebook group. It's called, REI Nation, Profiting from Passive Real Estate. Man, it took me a second to remember that one. If you're watching us on Facebook and you're interested in catching the rest of the podcast or even reading our newsletters, you can find us at thegrind.com. And if you just want to kind of send me an email, drop us a line anywhere on any of our social media, do it. I'm happy to engage. Love to connect with everybody out there. Until we get a chance to meet again on The Grind, guys, you guys commit to The Grind. We'll talk soon. And on Facebook Live, thank y'all so much for joining me today. I'll be looking forward to engaging with anybody if you have any questions. We'll see y'all soon. Bye.